be able to afford as much of a house, and therefore prices won't rise as they have been?
Well, I think there are several ways to answer that question. The first and easiest is the backup in mortgage interest rates that's already taken place, because mortgage spreads have widened out substantially, is already having an effect. We already see it in the weekly refinancing numbers and in the applications for new mortgages numbers, so we know it's having an effect. I think it is one of those things that is going to have to taper the optimism about how high prices will go. At the beginning of the year, there was a lot of belief that we would get 30% rise in home prices this year. That's a bit unrealistic against the backdrop of where mortgages are going now. And in fact, I've always been saying we'd probably get to around 10% rise in prices this year, and that's about what we'd be able to manage. And I still think that's the right number, is about 10%, which means most of it's already taken place in the system in terms of home prices. Another way to look at this is, what does this do in terms of the average investor's ability to afford home? Well, to be honest with you, the average homeowner, when you look at the median home price and divide it by median per capita income, we're already back to the pre-crisis levels on the ratio between home prices and median income. And the reason for that basically is income growth hasn't been strong. So you really have a consumer that to a certain extent needs cheap financing costs in order to continue to try to maintain what we've already seen start to happen in the housing market. And the backup in interest rates is just not going to be healthy for that market.